Okay, let's go ahead and book December. Again, we will continue in our live mode as if we were booking things as we go in live accounting, just to demonstrate the concept. Alright, so what do we have here? We have electronic funds transfer, and that's transfer to our personal checking account. So that's the draw, we're very familiar with it, but let's go ahead and book it, just solidify our knowledge. We can do it through journal entries, probably the easiest, one of the easiest ways to do it. Okay, let's make sure the date is set to where we need it. Yeah, QuickBooks Online has its own tendencies from time to time, but that's okay, we can work with that. Okay. Alright, so what's happening? Well, we know one thing for sure is that our bank account balance will decrease. Bank account is an asset. Assets decrease when credited. So here we go. What else is happening? Well, we know that our equity will be reduced, and we do it through members draw account, right? It's one of those kind of like accumulated depreciation, right? We close it, but unlike accumulated depreciation, we close it into the equity, right? So anyway, it's an equity account, the bottom line is, and equity is reduced when it is debited. So we have our debits and credits. Again, let's make sure we reflect it here. Bank account goes down, right? Therefore, it's credited because it's an asset, and equity goes down. It is debited, right? Makes sense. We take money out of the business, our ownership in the business is reduced, and our balance in our bank account is reduced. Okay, we have an invoice to enter, right? We can go ahead in live mode, we would just enter as it comes in, doesn't mean we paid right away, so we're going to add bill, right? That's the way QuickBooks has it. Alright, bill date, let's change that. Here we are. Okay, we have restaurant supplies. Alright. Here it is. Okay, let's make sure we enter bill numbers. Alright, good. We'll enter it here too. So again, at this point, very important to understand what's happening, right? We're just entering the invoice. We're not paying it yet. Right, so it's not impacting our credit card account, it's not impacting our bank account, it's impacting our accounts payable. Right, accounts payable is a liability, therefore it goes up, liabilities go up when credited. What else is happening? Well, our expenses on restaurant supplies go up, right, and therefore debited. So here it is, right, debits and credits are in balance. Very important to understand these amounts, right? So this amount right here, right, it's a debit to account 6100, and this amount, which is sum of amounts here, and in this case it's the same, right, this amount right here is a credit to account 2100. Even though we don't see the 2100 anywhere here, it's behind the scenes, and that's what's important to understand, right? QuickBooks tries to make things user-friendly, and sometimes they go a little overboard, right? But we need to know that, again, once we book it, our accounts payable account balance will go up by this amount, right? So here we are. Right here it saves in schedule, right? And we're just gonna save and close. We're not gonna schedule the payment. We're gonna save and close. All right, here it is. Okay. Okay, next we have another invoice. Okay, here it is. We're going to enter it to add bills. No. Date, correct. Okay, let's enter the invoice number. Okay, all the expense accounts are right here, so that makes it easier. Just gotta double check that everything is correct. Yep, the bottom line. So again, here, because we're booking it in live mode, just because we're entering an invoice doesn't mean we'll pay it, right? So it's gonna hit our accounts payable, and accounts payable is a liability. It goes up when it is credited. So here it is. And then we got to have our debits, right? So what's going on with debits? It's hitting all of these expense accounts, right? So let's go ahead and enter them just to demonstrate the point. Okay, 6210. Right? We're short, right? So 150. So one more. They're a little bit out of order here, right? But nevertheless, that's our 1,000, 150. I put it at the bottom. I skipped that. Here we are, right? Our debits equal our credits. That's what's important. These expense accounts will be debited, and therefore they will increase. Our advertising and promotion, repair and maintenance, so on and so forth, they will increase, right? What else is going to happen? Our accounts payable balance will increase as well by this lump sum, right? And again, being a liability, it has to be credited to increase, right? So here we are. Save and close. We have another invoice to enter. Let's go ahead and do that. Okay, make sure we change the date. Okay, good. Okay, cleaning supplies. Okay, amount. Let's update it. Okay, same thing here, right? What's happening? Well, we know for sure that the expense account is going up, right? But expenses go up when they're debited, so we can enter that. And again, to walk you through it, what has to be credited? Well, we don't see a bank account, right, being impacted, and it shouldn't. We're just entering the invoice, right? We don't see our credit card account being impacted. And that's right, we're not paying it, right? We're just entering it. And therefore, the only other account that is being impacted is accounts payable. And it is a liability, and therefore it is credited because it goes up. Makes sense. We owe money to Clean Depot, right? And that's our liability with them. Here we are. Save and close. All right. We have a deposit receipt, right? So we made a cash deposit. That's from our cash sale. So again, here we're going to book it through journal entries. Okay. Again, what's happening? What do we know for sure? Well, bank account balance will increase, and it's an asset, therefore we debit it. What else is happening? Well, what's the source of the money? Sales, right? And sales slash revenue go up when credited. So here it is. Again, let's dissect it here. Okay. What's important is that debits and credits have to equal each other, and we see it on this interface very well. Here's your debits and credit. And it makes sense, right? Because again, assets, they increase when they're debited, and sales slash revenue increase when they're credited. All right, so we're all good to go. Let's go ahead and book it. Next, we have an invoice from Food Traders. Let's go ahead and enter that one. We can go ahead and go back at bills. Okay, bill number. Okay, for purchasers. All right, let's update. Okay, here it is. Again, debits and credits. What's happening here? Well, we're just entering the invoice. We're not paying it yet, right? So it's going to hit our accounts payable. Accounts payable is the liabilities. Liabilities go up when credited. What else is happening? Well, our expenses are going up. With purchases, expenses go up when debited. Here it is, debits and credits are in balance. This amount right here, it's a debit to account 6200, and it is also a credit to account 2100, accounts payable. It's not shown here, but this amount right here, right, identical to this one because we don't have any more. It is a credit to account 2100. Okay, save and close. Okay, we have another invoice to enter. Alright, so utilities to go. Okay, good. Alright. Okay, good. Okay, let's make sure we're copying and pasting in all the elements, so in case we look for it. So again, what's happening here? Expenses going up. Again, as we covered in previous episodes, right now expenses are going up on accrual basis, not cash basis. That's the big difference. So once we pay them by check or credit card, they'll be recognized on cash basis as well, right? But right now, we're just accruing these expenses, and that's the difference between accrual and cash basis accounting, right? Just to kind of side note, as I mentioned in previous episode of the simulation, that until we pay these expenses with, our bank account or credit card, they're recognized only on accrual basis. So if we're a cash basis taxpayer, which in this case we are, right? We're just an individual, and individuals are cash basis taxpayers. This is not recognized for tax purposes until we pay it. So right now, again, we're booking it into accounts payable, but nevertheless, the expense did take place, right? We're accruing it. So expenses go up, and accounts payable account goes up as well. Okay, here it is, debits and credits. This amount right here is a debit to account 63,100, all right? And this amount right here is a credit to account 2,100, even though we don't see it here. All right, we have another invoice right here from soft drinks. Okay, let's go ahead and add this bill. Okay, make sure we change the date. Drink purchases, okay. Okay, and amount 37983. Okay, good. Again, same situation here, just like before. Accounts payable going up, even though we don't see it on this interface, it's there. And expenses on drink purchases go up. Here it is, debits and credits are in balance. They have to be for us to book an accounting transaction. So this amount right here, right, it's a debit to account 6,300, all right? And this amount right here is a credit to account 2,100, even though we don't see it. That's fine. Okay, we have a transaction receipt here. So what is happening? We're paying an invoice from soft drinks using our credit card, right? So now we can use this button to pay. And now when we pay them, we're not going to impact the expense account. We will only impact our accounts payable account. However, at that point, our expenses will be recognized for cash basis purposes. Okay, anyway, let's go ahead and pay it. So we have our soft drinks right here. We're going to pay it with our credit card. Make sure we recognize it. Our payment date. Okay, make sure we set it correctly. Otherwise, we would have to look for an error like we did in our previous episode. Okay, good to go. All right, all is good. So what's going to happen once we book it, right? So one thing we talked about, it's going to impact our accounts payable. Accounts payable is a liability and it will be reduced. Liabilities are reduced when debited. So here we are. What else is happening? Well, we're paying it with our credit card, which, you know, is another liability. We're moving it from one liability to another. So here it is. This amount, $379.83, right? It is a credit to account 21,100. This liability goes up, and it is a debit to account 2,100, right? This liability goes down. Okay, so here we are, save and close. Okay, here we will write a check. In this case, we wrote it by hand, and we will basically pay an invoice from utilities to go using this check, and we will post it. But instead of print later, we will essentially book it as if, you know, it happens. You know, we couldn't print, our printer didn't work or whatever else, and we wrote it by hand, but now we need to reflect it. So we're going to again pay bills. Here's our utilities. Make sure that instead of the credit card you have bank account selected. Date needs to be set to correct. Okay, and then the check is 1034. Make sure it's correctly. You see print later is unchecked. That allows us to enter it. Okay, amount is correct. Okay, we're good to go, right? Before we do that, let's reflect what's happening here. Well, one thing for sure, our bank account balance will be reduced. Bank is an asset, bank account is an asset, therefore it has to be credited. What else is happening? Well, our accounts payable balance will be reduced as well, right? Because we're paying it down, we're paying this invoice, we owe less money, in this case to utilities to go. Therefore, this liability has to be reduced, and liabilities are reduced when they're debited, right? So here we are, debits and credits are in balance. This amount right here, it is a credit to this account, 11,100, and it is a debit to accounts payable, 2,100. So save and close. Then we have a receipt from a gas station, right? So this one we can book through, you know, essentially expense module. Okay, so here we are, expense. Here it is. Credit card account selected. Great. Let's just change the date. Okay. Okay, great. We have our fuel selected. Here it is. Here it is. All good. Make sure we update the amount. Okay, great. So again, let's make sure we understand what's going on in terms of debits and credits. Well, we know one thing for sure, right? We purchased it with a credit card, so we'll owe more money. So being a liability, credit card is a liability, it has to go up. And liabilities go up when credited. So let's go ahead and do that. What else is happening? Well, our expenses on fuel go up. So let's go ahead and book that. Here it is. All right, debits and credits are in balance. Okay, this amount right here is a debit to account 63,200, and this amount at the same time, right, it is a credit to account 21,100. Being liability, it goes up. Being expense, this one goes up, right? We're good to go. Okay. What's next? We have a cash deposit, right? So we had some cash sales that we're going to record through journal entry. Alright, so in this case, okay, cash deposit is 593985. Good. Okay, what do we know? We know that our bank account balance will be going up, and being an asset, it has to be debited to go up, right? So here we are, and this is our cash sales. And then what else do we have? Well, we know that our sales are going up, right? And sales slash revenue go up when credited, and therefore they have to be credited here. So here we are, right? Here we are, we're going to debit our bank account, and being an asset, it goes up. And then our sales slash revenue goes up when credited, right? And same amount, all of this money came from our sales, and therefore, again, sales go up right here, and it's well shown right here in debits and credits because it's a general journal entry. So we're going to save and close. Okay, great. Let's continue. What else do we have? Next, we have a transaction receipt where we're paying a bill from food traders, right, using our credit card, right? So let's go ahead and do those. So we can go ahead and go to our dashboard, click our pay bill button. Right, here's our food traders right here. Okay, let's make sure we select credit card because that's how we're paying it, right? Make sure we select the correct date. Alright, good. And then the payment amount is going to be equal to the balance. Sometimes it posts it, sometimes it doesn't. Here it is. Okay, so what's going on in terms of debits and credits? We know that we're going to pay it with our credit card. So the amount we owe, the balance on that credit card will go up, right? So we know that much. What else do we know? Well, we're going to be paying down our accounts payable, and accounts payable is a liability. So when it is reduced, it has to be debited. So here we are. Debits and credits are in balance, right? This amount, the amount of payment right here, it is both. It is a credit to this account, 21,100, and it is a debit to account 2100, right? So here we are. We can go ahead and pay this one. Okay, here we are, saved. Okay, what do we have next? Next, we have a transaction receipt where we're paying to go, right? To go packs. Again, same thing. Pay bills, to go packs. Okay, credit card. Okay, make sure the date is correct. Alright, all good here. Alright, so again, what's going on in terms of debits and credits? Our accounts payable balance will be reduced, right? And being a liability, liabilities are reduced when they're debited. Okay, good. And how are we paying it? We're paying it with a credit card, right? 21,100. That's our general ledger account number for that one. And it is a liabilities, and liabilities go up when credited, right? So we will owe more money to the bank on that credit card, right? So this liability goes up, but at the same time, we're paying to go packs, and our liability with them through accounts payable will be reduced, and therefore it is debited. Okay, next we have a transaction receipt. It's a bank transfer. So what we're doing here is that we're paying down our credit card, right? And we're transferring money from our bank account to do so. So again, we can do it through our expense module. It has a button. We can do it also through general journal entries. But right here, we actually have paid down credit card. So it's one of those things where QuickBooks wanted to make it convenient, right? So here we are. We have this interface. So we're going to select the card. And we're going to pay 2,343 and 76. Okay, 15th. And then we will pay it through our bank account. Again, here we are, right? We can go ahead and reflect all of that right here. So what's happening? Our liability with the credit card will be reduced. We're going to pay it with our bank, right, account. So we're going to transfer money from our bank account, and therefore bank account balance will be reduced as well. Okay, so here we are. This amount right here, it is a credit to account 11,100, and therefore it reduces it. And this amount right here, it is a debit to this account 21,100, and therefore it reduces it because it's a liability, right? Liability is reduced when debited, right? And assets are reduced when credited. And that's what's happening. Our liability is reduced and our bank account is reduced because we're paying it down, that liability, with our bank account. Okay, so save and close. Okay, we have electronic funds transfer notice. So this is from our merchant account. So this is the money that comes to us from our credit card paying customers. All right, they paid with credit cards. That money went to our bank. The bank processed them, and now they're depositing to our account. So that one is pretty straightforward. General journal entries. All right, it's our merchant. All right. Here we are. Again, what do we know for sure? We know our bank account will go up, right? Bank account goes up when debited. And what else is happening? Well, our sales, because the source of this money is sales, our sales go up and therefore they're credited. So let's make sure we're reflected here. So our bank account is an asset, and assets go up when debited, right here. And again, what's happening? This money comes because of our sales, and therefore our sales / revenue go up, and those go up when credited. Great, right? Debits and credits are in balance, and we can see it right here as well. Good to go, save and close. Okay, well then we have a receipt, right? We paid down our mobile services provider, and we got a statement that, you know, it's linked to our credit card, right? So again, we can book it through our expense module. We're in it. Okay, so we're just gonna book this expense. All right. Okay, we're paying it with a credit card. Great. Okay. Okay, great. So telephone services, all good, all good. Okay, so again, what's going on in terms of debits and credits? Well, in this case, we're booking it straight to our credit card, right? The mobile service provider just gave us, send us a receipt, it's tied to our credit card. We don't need to enter it as an invoice and then pay it down. So in this case, our expenses go up, and therefore they're debited. And our balance on our credit card goes up, and therefore it is credited, because liabilities go up when credited, all right, and expenses go up when debited. Okay, so here we are. Let's go ahead and save and close it. Okay, then we have an ATM withdrawal, right? So we're taking money out of our business essentially. Again, there are multiple ways to do those withdrawals. One of the ways we can do it is, you know, through general journal entries, right? So let's make sure we always remember to use those. Okay. Okay, so what do we know for sure? Well, we know our bank account balance will be reduced, therefore it has to be credited. What else do we know? we know that our equity will be reduced as well because we're taking money out of the business, right? So equity is debited and therefore it is reduced, and account 3700 is an equity account. And our bank account, being an asset, is reduced when credited. Okay, debits and credits equal to each other. We can see it right here as well. So we're good to go. Okay, next we will write another check by hand. See right here, it's written by hand instead of printed, and we will book it, all right, through bill pay module. So let's go to our dashboard. Here we go, pay bills. All right, this time it's Clean Depot. Okay, make sure that we select bank. Okay, date is correct. Okay, check is correct. We're not going to click print later this time. We did it on the previous month simulation, right? So everything is selected. So again, what's going on? Well, we know for sure that our bank balance will go down, right? And being an asset, it has to be credited to be reduced. What else is going on? Well, we know our accounts payable balance will be reduced, and being a liability, it has to be debited to be reduced. Okay, here we are. Debits and credits are in balance. All right, good to go. Save and close. Again, this amount right here, it is a credit to account 11100, and it's an asset, and therefore when you credit it goes down. Makes sense, right? This money will be taken out of your bank account, right? And at the same time, this amount is also a debit to account 2100, which is accounts payable. Makes sense, right? Liability is reduced because we just paid down that bill. The business no longer owes money to Clean Depot Inc. Okay, let's go ahead and book it. Okay, we have another cash deposit. We know those by now, all right? So general journal entries. We're good. Okay, bank account goes up, being an asset, right? Comes from cash sales, and then our sales go up as well. Here we are, right? Again, just to demonstrate, bank account asset, assets go up when debited. Sales account / revenue account, because that's the source of the money, go up when credited. Here we are, debits and credits are in balance. Again, on this interface, it's very easy to see that part. Okay, save and close. Okay, another check. We're going to write another check, this time to pay the bill from Big Lease Company. Again, pay bills. It's our last one. Okay, again, we're not going to check print later like we did on the last one, right? This time we just enter it straight up. Okay, good to go. So again, let's make sure. See, even though this, if you remember, this invoice hits multiple expense accounts, in this case, when we're paying the invoice, we're not touching those expense accounts. We're only reducing our accounts payable balance, right? Because expense accounts were hit before. There is a little nuance that takes place, and these expenses are no longer accrual expenses, they're now cash basis expenses. Again, it's a subtle detail that for the most part a concern of your tax preparer / CPA accountant. But anyway, what's important for us to know is what's happening behind this interface. So let's go and show it. Accounts payable balance is reduced. Okay, what else is happening? Our bank account balance is reduced as well. Here we are. Accounts are in balance, debits and credits are in balance. So this amount right here, it is a credit to account 11100, and it is a debit to account 2100. Even though you don't see 2100 here, it's there. Trust me, it hits accounts payable. We're good to go. Save and close. Okay, we have a gas station receipt we're going to book. We do those through expense module. Very easy. It's just an expense we're going to book right here. Good to go. Credit card, all good. Change the date. Okay, fuel, good. Let's copy and paste. Okay, let's see what's happening behind the interface, right? Well, we can see one of them. Well, we can see both of them right here, but let's solidify it. Okay, the liability, and this time we're paying our fuel expenses with the credit card. Liability goes up, so this liability, for it to go up, it has to be credited. What else is happening? Our fuel expenses go up as well. Fuel expenses and expenses in general go up when debited. Here it is, debits and credits are in balance. All right, we're good to go. Save and close. Okay, then we have transfer to personal, right? That's another draw that we did. So let's go ahead and do that one. General journal entries, one of the best ways, right? So here we go. Okay, our bank account balance will be reduced and therefore it has to be credited. Okay, our equity account will be reduced as well and therefore it is debited. Okay, equity goes down when debited, assets go down when credited. What's happening here? We're taking money out of our business, therefore our bank account balance is reduced, therefore it is credited. And our ownership, our equity in the business is reduced, therefore it is debited. Makes sense, right? We take money out, we owe less in that business, right? Less of it belongs to us. What else is happening? Well, we took the money out, right? So it came from the bank, so bank balance is decreased. Debits and credits, they're well depicted here. We're good to go. Okay, then we have a cash deposit, right? Those are pretty straightforward through general journal. All right, so we have cash sales. Again, we know one thing for sure, right? Sales go up, sales slash revenue go up when they're credited. So what else is happening? Our bank account balance is going to increase, and bank being an asset, it goes up when debited. So here it is. Again, let's make sure we reflect it. I'm switching those up just for kicks and giggles, just so you get comfortable with it, and that's the objective. You need to know your debits and credits, and then you'll owe those books. They'll become your own. So here it is. Debits and credits are depicted right here. Asset goes up when debited. Bank account is an asset, therefore we have to debit it, and then our sales go up, sales slash revenue go up when credited, therefore we credit 41,100. We're good to go. Okay, next we have a notice of electronic funds transfer from our merchant account. That's again another sales element that we have. We're going to book it through journal entries. All right, so that's our merchant account. Okay, it came in at the end of the month. Okay, again, this time we switch it up a little bit more, but the result is the same. Bank account is an asset, we debit it to go up. And then our sales go up as well, right? Because the source of this money is sales, right? So sales go up, we credit them, Bank account balance goes up, we debit it. So here it is. Just to solidify. Okay, debits and credits are in balance, and we can see it on this interface, right? Debits and credits are in balance. We're good to go. Save and close. Let's go back to our dashboard. And that completes booking transaction live mode for the month of December.